This will be a good conversation with Jay Martin, who has interviewed me over the years, has a fantastic YouTube channel and has some real interesting thoughts on markets. And we're going to get into a lot of different topics here. And I will have this available on all your favorite podcasts soon enough. My name is Michael Guyot, publisher of the Lead Lag Report. Joining me for the hour here is Jay Martin. Jay, for those who are not familiar with your background, talk about who you are, how'd you get interested in markets, especially the behavioral side, and why are you doing all these interviews in a not so similar way than I am?
Yeah, certainly. Michael, thanks for coordinating this. It's going to be fun. My name is Jay Martin. I do a few things. I publish a weekly newsletter. I manage my own cash in the market. I'm very active specifically in the spec market, so early stage stuff. That's where I like to spend my gambling time anyways. So my portfolio's relatively barbelled in that I have a lot of hard assets, what I consider super secure, and then I like to go super deep into the higher risk arenas on the other end and not much in the middle. So I publish a weekly newsletter where I talk about that. I absolutely do not give investment advice, but I love talking about what I'm looking at and why, where I'm putting cash and all that stuff. I run a podcast. It's called The Jay Martin Show. It's also a YouTube channel. It's where I've had Michael on as a guest a few times. And the content we create is not specific to the markets. We really get into all things macro. So we, might be talking about even like cultural and social trends, to be honest. I feel like, I approach the markets very much from a sentiment and behavioral standpoint. I'm not a technical guy. I look at human behavior and decision-making and sort of investor psychology and decision-making psychology. And that's what guides a lot of my theses and thought processes. So diving into that content, super fun. Just the sort of the nature of human beings and why we make the decisions that we do, good and bad. I landed in that, content creator, I guess, role after running conferences for about 12 years. So I used to run an event business. We had conferences mainly finance focused on the commodity sector, tech sector, cannabis sector when that was emerging, health science, a variety of things. And that was the primary business for over a decade. When COVID put that on pause, it was a blessing in disguise because it's actually not a great business. When events work well, they work really well, but lifting a new one off the ground can be, huge cash outlay, lots of risk, and just like an obscene and infinite number of unknown variables, even up to the day keynotes not showing up, all that stuff. So pivoting to a media company has been a boon and super fun and complements my portfolio much more so. And just recently, we actually did get back to hosting live events. We hosted our first in-person conference last May and had a couple awesome keynote speakers, former Prime Minister of Canada, Stephen Harper, former President of Mexico, Felipe Calderon, a lot of the macro guests that probably most people on this channel know, people like Danielle DiMartino Booth, David Rosenberg. We had about 80 keynote speakers in total, about 4,000 attendees, all focused on commodities up in Vancouver, British Columbia last May. And we'll do about 1 or 2 events a year, but otherwise focus on the media stuff and the portfolio.
I'm curious if with all of the excitement around the commodity space now, you've seen increased attendance or more people wanting to sign up than before? Because I think that's kind of an interesting tell as to whether the crowd is really into a particular investment thesis, right? If you see more and more people wanting to attend conferences.
Yeah, 100%. And, I could describe a conference that we ran in 2011 that was focused mainly on the gold and silver space, precious metals, base metals. And you couldn't walk down an aisle. It was just absolutely jammed, elbow to elbow, shoulder to shoulder. And as we know now, that was, peak gold market, peak commodities market, hard commodities anyways. And, we were walking around the show, slapping yourselves in the back thinking, we're just nailing this, right? This thing, there's 11,000 investors that showed up for a 2-day event. And the market just free fell for the next 4 years straight. So yeah, it's a great indicator, Michael, like attendance, and not just attendance, but sentiment, right? I make a point of connecting with as many people as possible at these events, open most of my sessions up to Q&A, just to get a sense of like where is sentiment lying right now? Are people feeling scared? Are they feeling bullish, and why? And that drives a lot of my decision making. Absolutely. I think it's an important indicator. You got to play the hand that you're dealt, right? And I connect with people. I interview people for a living. I talk to people for a living. I get to write about it in my newsletter. I host events. It's all people driven. And so, that's the data that I get access to, and that's what I leverage.
Yeah, I think that contrarian aspect is actually really interesting. I mean, you can even see that in the way some of these conferences around Bitcoin were just absolutely manic and insane in terms of attendance. And then we know what's happened to Bitcoin the last year. So it is interesting as a on the ground tell for when maybe there's an extreme to start to fade.
Yeah, 100%. And it's terrifying to be the one running into the burning building, but you get paid if you do that appropriately.
Yeah, no, of course. I mean, you want to see that, but at the same time, there's sort of just an investment aspect to that, which is curious as well. So there's a lot of different areas to hit on based on what you just said. So let's first go with the decision-making psychology aspect of investing that you're fascinated with. You mentioned that you do a lot of early stage type of investing. I'm going to assume it's more on the startup companies on the private side, looking for capital, looking for help, whatever it would be. How do you assess behavioral implications of entrepreneurs in terms of their likelihood of success when you look at a potential investment that's not a public stock?
Well, the benefit of investing early stage, there's a couple. Number one is that you're investing not so much in a product or the potential of an industry to move. You're investing in the judgment and decision-making and integrity of typically one or two individuals. If you're looking at even, publicly traded spec market companies, market caps sub 250 million, say, or even last week I took a position in a $30 million market cap company and have a high level of trust in the CEO and their team and they're positioned right. But yeah, you are investing in the people. It's a cliche to say, invest in people, but at the early stage, like that's all it is, and so first of all, take the time to meet the management team, because at that scale, they will absolutely take your call. They'll talk to you at a conference, whatever it is, and getting to know those individuals before you let them have an adventure with your cash is hyper critical. And then I look at who else is, you got to look at all the ancillary factors, like definitely the resume. And, I'm not opposed to betting on the rookie. For most of my life, I've been the rookie soliciting bets, but, success begets success. And so you want to look at, what's this individual done in the past, right? Am I betting on their first rodeo? I'm not so sure I'm comfortable with that. And personally, I don't often do that. In special circumstances, sure, but I want to see a couple wins, in the track record. And then who else is in the deal? What other shareholders are involved? And do I know them? Are they credible? What's their track record like of picking winners? And so, by sourcing all the people involved, not just the leadership, but, the extended management, if somebody hits a win, they'll typically carry that crew with them to their next deal, whether it's the shareholder base, the management, et cetera. And so, but it's having the conversation, step one, absolutely, because you are betting on the decision-making of one or two individuals and their ability to surround themselves with other smart people.
What's funny about that is that's something that people should be doing for anything they put money at risk in, right? Whether it's an early stage company or a multi-billion-dollar large cap company. But when you don't have a chart, you have to go to the people and actually do a deep dive. When you have a chart with a public stock, there's this laziness is not quite the right word, but there's this temptation to not do any kind of real dive because, hey, it's going up and to the right. And I think that makes for an interesting dynamic because you probably have more true investors with early stage companies than you do with the public stock market, even though the whole stocks for the long run is supposed to be about being a true investor, which means actually looking at, the individual idiosyncratic aspects of management, of products, and really kind of getting a deep dive.
Yeah, 100%. And it's you should do that if you can. And it's funny, if you're making your investment decisions based off of a chart and that chart is going up and to the right, it's a completely rational assumption to assume, this chart has looked this way for the last 160 days. Longer, 1,000 days, like why would it not look that way the next? Like people often criticize investors who jump in late as being greedy and blind, but they're often very rational and making very rational decisions. You see a pattern that's been consistent for 2 years. What's there to make you believe that pattern would change? Often not much. And so it can be tricky. It can absolutely fool you. And you're 100% right.
Yeah, and essentially because that also goes to the name of the space. The discipline is freedom point, right? Because when you're investing in early stage companies, you want to see a degree of discipline, but also some flexibility in case market conditions force a pivot. But when you're investing in a public stock, it's your own discipline that's the real problem, right? Because that's going to determine the performance rather than if you're in a small company that's not publicly listed where it's the discipline of management that determines your performance more so than anything else.
Yeah. And if I've learned one thing, I've probably interviewed over 400 money managers over the last 3 years. And if there's one consistent in the true high performers, and I definitely apply this to my own portfolio as well, is that, everybody's got rules and creating those rules is the easy part, but sticking to them when emotions run hot, that's very, very tough. If you have, buying a stock's the easy part, right? Selling is the hard part. That's the harder part of the trade. And so having some rules there that help you take the human element out of that decision-making process that allow you to police your own emotion. Because, if you've never experienced the greed or the fear, right? It's tough to anticipate how you're going to respond to that. And step one for me is understanding my time horizon. Like you mentioned this, trading versus investing. Like I'm absolutely an investor. A short-term position for me is maybe 3 to 5 years. And so therefore, if I've jumped into a position, I've got myself in trouble in this regard within my newsletter when I share things that I'm looking at or things I'm building a position in, because people often think of themselves as investors, but they act and think like traders, and that can get you in a world of hurt. If you're building a position that I anticipate being in for 5 to 7 years, you build a position in alongside me, the share price doesn't just go straight up, maybe it corrects. And for me, it's like, well, I'm not worried because I've got my conviction in my long-term thesis, and what happens in the near term doesn't impact that at all. But if you're not confident in that, then you can get scared out of a deal real fast. And so understanding what kind of investor you are, and if you don't know, spend the time. It's super, super important. And step one, I think, is understanding how much time do you have to invest in being an investor. There's a lot of people that maybe have an hour or two a day and they want to be day traders, and it's like, I don't know how that's going to work out for you. Right? You have an hour or two a day. You want to be a value investor? You can make that work. I make that work. Right? I have market time until about 7 or 8 a.m. Pacific time. And then my operational business runs away on me. And so that's the time I allocate. And if I'm disciplined with that, things work out. But spending the time to determine like how much time you have consistently to dedicate to your portfolio, not this week or this month, but over time, right? That'll help you get to the answer of what kind of investor are you. And maybe you are a day trader or a swing trader, but figure that out first.
Yeah, and that's an important point. And tying that into the rules-based discussion for a moment, it takes time to figure out what the rules you want to follow will be, right? To figure out not only what kind of investor you are, but also how do you want to express that in a disciplined, regimented type of way. But once you have those rules, then you can arguably spend less time, because then you're following a set of variables, right, that you gravitate towards, that you're a fan of. But of course, as we know, the dilemma is that even if you have some rules-based approach, that's not a guarantee that you're going to necessarily do well, right? Because yes, you take the emotional aspect of it, but you can't take out the randomness aspect of investing. Mm-hmm. And that, I think, is really challenging for people to intellectualize, because I've seen many times over myself in my career, people that are excited about some backtest, some approach where you have a rules-based approach, years of studying and researching, and then it goes live. And then if you're not disciplined to stick to the rules and you happen to be at the exact moment in time where a drawdown hits, well, then if you don't stick to it, you've just wasted all of your prior time invested. And if you do stick to it, now, even though you're gone through a drawdown, you actually have a more efficient usage of your time going forward, because the rules don't change, right? So it's a really challenging balancing act, I think, for public investors in terms of where they allocate their time, and once they've allocated their time, making sure that it's not just sunk cost fallacy if it's not working in the here and now.
That's right. Yeah. And exactly. And if you're doing this off the side of your desk, you're not a full-time money manager, then it's tempting to be a bit of a chameleon, right? If what you're doing is working and you're generating returns and you're feeling really smart and competent, and that's great. And when that game ends, it's tempting to look at what other people are doing and follow them, right? Whereas often sticking to what you know is really difficult, and the best trade available to you can sometimes just be patience. And frequently I see people flip very quickly. If what they were doing stops working, they'll flip and follow, some other leaders down a different path they're unfamiliar with and get burned. And it's just that FOMO mindset. It's like, well, they're making money over there, so I'll try that too. And if you have the time to dedicate to, refining your skill, great. But if not, it can be dangerous.
So let's talk about barbell investing for a moment. I'm a big fan of that concept, right? You go, 80, 90% of your portfolio, very conservative, and then, the remainder, small percentage, ultra aggressive, so that, at least in theory, on average, you have moderate risk, but it's a much more, to use a Taleb term, anti-fragile way of constructing portfolio of risk assets. But the challenge this year, I want to hear your thoughts on this, Jay, is that 80%, 90% conservative really hasn't been conservative, right? So in other words, I always use this example when I talk to financial advisors. If you were to look at the AGG ETF, which is AAA aggregate bond ETF ex dividend. The price of that AGG bond ETF, which pays out a dividend every single month, is below the level that it was during the COVID crash. Right, so you can see complete devastation of the bond market. That which is conservative has ended up being not conservative at all. What's more maddening, though, than that is that junk debt, if you look at HYG as a proxy, ex-dividend to make it a fair comparison against AGG, is still above its COVID crash low. So that which is conservative ended up being ultra aggressive. And a lot of that we know is because of this tremendous sell-off in treasuries, which is really what AAA is ultimately largely allocated to. So when you think about defining that conservative part of a barbell portfolio, what are some of the things that give you confidence that what you're actually investing in will remain conservative? Because I think this year has proven that a lot of these sort of categories of what one should invest in based on risk tolerance seemingly just doesn't want to hold.
Yeah, it's a great question. And I'd say that I am very primitive in that regard, Michael. When my conservative end of the barbell are items like physical gold, and gold gets hated on because of how boring it is as an investment. And I answer back, that's the point, right? That's the point of a safe haven. It's not supposed to do much. If it was doing a ton, you couldn't really call it a safe haven or a conservative end of that barbell. And so, you got to make your own call. I'm definitely not a bond expert, and I would probably lean on someone like you for direction in that regard. The conservative end of my barbell is gold, it's real estate, and it's cash. And it's really that simple. If I were to throw a wrench in that, I would say that I also now put Bitcoin in that box. And I know how crazy that sounds given the volatility. Like, how could you put such a wild speculation in the conservative end of your barbell? But, what are you supposed to do with something like Bitcoin? You just have to decide how you want to define it, because I think it's very undefinable. It's too young still. And I've just decided that's where I think that is going to end up eventually. I believe it's kind of performed maybe like gold would have if gold didn't have the paper market. But, we'll have to wait and see here. But historically, yeah, it's, what is proven as a store of value through the rise and fall of hundreds of markets and hundreds of empires. Let's be honest, it's gold and land, right? And so, yeah, but I approach it with this mindset. Like, if rule number one is staying alive, right, then where can I put the wealth I generate on the risk end somewhere that is really, really robust to all sorts of black swan events? And, if you're a student of history, there's a few things that stand out, but gold and land are pretty basic, and they have done that, right? And so I go that basic, I suppose. I'm not even in the bond market, and I like cash right now. And I think that you could say that's questionable as well. But the U.S. dollar maybe has a lot of flaws, absolutely. But you just look at the Dixie. Where do people still go today when shit hits the fan? It's there, right? It's the only chart in the world that looks amazing. And
it's been the only real inflation hedge. Isn't
that
really
wild?
Insane.
Yeah, totally insane. And, having said that, gold looks great in every currency outside of US dollars and rubles, actually. But, so people ask why gold isn't performing. And it's kind of like, well, it actually is. What you're looking at is a US dollar story. You're thinking it's a gold story, but it's not, right? Gold's done just fine, except relative to US dollars. And I get, well, the world works in US dollars, sure. But everything's gone down relative to USD. And once that USD rally rolls over, and it will, I don't think it's going to crash, but it will roll over. Where that capital gets reallocated, I imagine is going to go to some conservative bets. We'll have to wait and see.
Let's go to some of the audience.
So my thoughts on that are that geopolitical risk has never been higher in the commodity space. We're looking at what I think is probably going to be super widespread sovereign debt crisis that's going to roll out over the next couple of years. And when that occurs, countries are going to look to nationalize any wealth that they have. So I, right now, am sticking to countries that have swap line agreements with the United States that couldn't nationalize assets to offend those. Really, I'm looking for Western alignment. I don't think I'm a doom and gloomer, but I feel like there might be a massive shakeup in the geopolitical chessboard this winter. And a lot of countries within the EU, UK, Japan probably as well, are going to have to look really critically at their relationships historically and moving forward, because their back's against the wall from an energy standpoint, which is the true, that's the true asset that powers the world. So I'm super disciplined right now with with my jurisdictions. And so I'm very limited, actually. I'm very exposed to both Canada and the US from a resource standpoint, certain South American countries, depending on their alliances. And I've pulled out a lot of jurisdictions that I used to love, right? And I've still got cash in Peru, actually, which you could say is questionable because they've been through, I think, 5 or 6 presidents in the previous 5 years. And their most recent was as socialist as they come, which was a massive threat to natural resource assets. But Peru is a country that's heavily dependent on its natural resources, and the leadership turnovers have been so intense that I wasn't so worried about one individual leader. I think things will shake out there. But Indonesia's got a history of nationalizing assets. I'd be a little bit worried about that. But it's a hard one to call, right? It's hard to bet on geopolitical outcomes. Very hard. So I stick to what I would consider to be predictably governed and safe jurisdictions with transparent rule of law.
Yeah, I'm going to dovetail that a little bit to Jay, your piece on choosing your own probabilities, which I think is just an interesting way of thinking about investing, right? Because you can be positive on a theme, on an asset class, but to your point, the geopolitics are what throw the probability off, right? So you've got to choose the probability, which means choose where it's likely to have more of a chance of rule of law, less of a chance of nationalization or geopolitical risk, even though there's always going to be some degree, but the probability is lower.
Agreed.
Now, okay, so you're in Canada. I know you joined the space yesterday talking real estate housing and talked about the Canadian markets for a bit. I'm curious to hear from your vantage point how you're viewing the housing market in Canada. Any thoughts on potential systemic risk that could be forming in Canada or not? Just kind of riff on that for a little bit here.
Yeah, certainly. So a couple stories I could share there, and one reckless gamble that I just made about a month ago. I haven't shared with my YouTube audience yet. They're probably going to skewer me for it, but I'll share it here, and then we'll see how things pan out for me. But a number that was shared in your chat last night, Michael, somebody spoke up and said that about 50% of Canadian mortgages are variable and therefore exposed to rate increases. I actually thought that number was higher, but I think time span matters. I believe in the last 12 months, it's actually 70 to 75% that are variable rates. And that's a number I got from Danielle Park at Venable Park Investment Council. And she's usually pretty on it when it comes to Canadian markets, specifically real estate. But, either way, it's really high. So yeah, is there systemic risk? Like, yeah, probably, right? Like I think a lot of people jumped into homes that it's questionable whether or not they can afford. Our banks are fairly well capitalized, so we're not looking at, I don't think, a super crisis, but an affordability issue, absolutely. Now, I just tend to look at real estate as a hyper-localized industry, though, and that's where I still see opportunities, to be honest with you. And let me just for example, I grew up in Vancouver, British Columbia, a city that for my entire life has been debating the housing crisis for my entire life. And still today, this is the number one headline within every election cycle, the only item that receives bipartisan support from every candidate in every party is that we need to do something about the housing crisis in Vancouver. And the crisis being that real estate is too expensive. And I attend these candidate meetings and everybody's nodding their head in agreement that we need to do something. And the candidates, pounding the table saying they're the one who's going to make the change. And obviously nothing ever happens. But I listen to this and I'm the only one in the room who seems to disagree. And I don't get it. If you look at a city like Vancouver, just poke your head out the window. Like it's beautiful. There's the Pacific Ocean on one side, coastal mountains on the other. It is safe, predictable, clean. It's legally governed. It's a market that's open to the entire world, very lenient immigration policies. Everybody wants to move there, and inventory is always going to be limited because downtown Vancouver it's got water on 3 sides of it. It's more or less an island. So you've got this really restricted inventory in one of the top-rated places to live globally year over year on anybody's list, open to the entire world. Why on earth would real estate there ever be cheap? Like I've never understood that. Yet I get it's a populist argument that's got to come up at every election. But it is what it is. And you can find articles going back to the 70s about what are we going to do about the housing crisis, and it's never changed. And I think there's some markets in the world that will always be like that. And they still go through their cycles, absolutely. Like there's massive speculative cycles that hit the Vancouver market, and those heat up and cool down, and that really affects the luxury properties the most. You know, somebody who, you know, is selling a condo for 10 million bucks. They can ask for a premium when overseas money is just looking to park cash. And that is a driver, right? You look at the Vancouver market, for example. Somebody asked last night on your chat about mainland Chinese money investing in Vancouver real estate and how much of a driver that is. And it's a big one. Absolutely. If you're based in China, you've made some dough, you don't trust your government, you want to get that money out of country. Well, Vancouver real estate's a great place for that. And historically, we've been open to that investment. So there's lots of vacant properties, and that is a big point of contention. And I understand that absolutely as contributing to, you know, rental crisis when there's so many properties that are just vacant. They use, you know, there's a lot of investors that use Vancouver condos as essentially a money garage. They just park cash there because they know it's out of country and it's safe. And if shit really hit the fan, they could flee to Canada and have a place to live. And I get that. And that's a question mark for me. If there's one thing on the table in terms of big trends that might change in Canadian real estate, it's that one. Because, you know, you could look at the United States and Europe essentially deleting, you know, 600 billion in US dollar reserve currencies from Russia and ask, is that setting a new trend in how central banks look at US dollars as a safe haven? If the United States can suddenly decide, you know, we're going to confiscate this if we deem you a bad actor. But the Canadian Prime Minister did the exact same thing maybe 6 months ago during the Freedom Convoy, right? He confiscated the financial assets of thousands of Canadian civilians because they contributed to, at the time, a completely legitimate GoFundMe page supporting and expressing their civil rights. And without any public discourse, their financial assets were frozen had they contributed to that GoFundMe page. GoFundMe is a very reputable site. The protest was organized in a legal way. It was a convoy of trucks traveling across the country. And anybody from the 18-year-old kid who got swept up and donated $20, they got their financial assets frozen. And that is an interesting event in itself. But I think we always need to look at these things as precedent, right? Like, okay, it happened. It's a static thing. The financial assets were eventually unfrozen. But it's always hardest to do something the first time. It's easier the second, third, and fourth time. You need less rationale or reason. And so I'm curious how strong of a message that sends to foreign investors who have always seen Canada as a safe haven for capital after a message like that has been sent and action like that taken, you know, to Canadian civilians. I mean, that was crazy. So if there's cracks in that trend, I think they may be beginning to show, and I don't know how dramatic, if at all, it's going to be, but that would be a significant impact if foreign capital stopped investing in Canadian real estate. And pros and cons to that, to be honest with you. So yeah, there's a couple thoughts.
No, that's actually, I think that's actually a fascinating point, right? Because you're right, it sends a message that maybe they didn't really quite intend, which could have longer term ramifications, you know, for that capital that's coming in. I think it's actually a fascinating point. Let me reset the room. So everyone here, please make sure you follow Jay Martin on Twitter. Check out the Jay Martin Show on your various podcast platforms, as well as YouTube. Again, my name is Michael Guyad, publisher of the Lead Lag Report. Let's go for another question. And let me maybe add to that, because I think it's interesting, because I had Stephen Panwasi on one of these not too long ago, and you know, he made this point that in 2008, Canada really didn't feel the real estate paying anywhere near like the U.S. So there was almost a moral hazard aspect to the housing market in Canada, which means that even though, yes, the banks may be strong and shored up, the regulatory response wasn't there because the crisis really wasn't there, which then could have other implications if a crisis actually does one day come to Canada when it comes to housing.
Yeah, both that and the lack of scar tissue, right, from the people themselves. You're absolutely right.
Exactly.
We didn't get it. We didn't learn that lesson. You know, we didn't. I mean, thankfully, we didn't have to, right? There's pros and cons to that. So that memory doesn't exist in, you know, the demographic that's buying homes in Canada. Yeah, in terms of like default rates, you know, honestly, I'm not sure. That's not I don't spend enough time focused on that, so I couldn't really comment on that intelligently. I just bought a place. I mean, I was going to tell a little gamble that I made. But I mean, we'll see if it pays off for me here. But I locked in a cheaper mortgage about 4 months ago, knowing, you know, we all knew rates were going up. It's like, well, I'll lock in a rate right now, and there might be this scenario that unfolds where I've locked in a relatively cheaper rate than what we end up seeing 3-4 months down the road, and that may inspire some panic selling and could contribute to a situation where I've got a reasonable rate and we're seeing values fall for a brief period of time before my rate expires. And that did occur. You know, I ended up, there's a building in Squamish, the town that I live in, which is very similar in terms of how I describe Vancouver. Squamish is 45 minutes north of Vancouver. It really is a very slim bench sandwiched between the Pacific Ocean and the coastal mountains in a corridor called the Sea to Sky. And it's called that because it's what it is. The Pacific Ocean really crashes up against the mountains, but there's this slim bench where there's a town on the way to Whistler. That's where I live. And it's massively restricted in terms of development, hugely attractive and beautiful. And it's very unique in that our town council was incredibly unorganized for the previous 30 years. And so as Vancouver boomed and Whistler boomed, nothing happened in Squamish. The Olympics came and went, in the neighborhood. Squamish didn't get as much as a new coffee shop. And that's changed as of about 10 years ago. And so the amenities are picking up and it's become a very desirable place to live. I'm very bullish on Squamish. Like I said, I tend to look at real estate as hyper localized. And so, yeah, there's a penthouse building and the owner got in a bit of trouble and I saw him reduce his asking price twice. I made him an offer significantly under asking. And here's the controversial part of this investment for me. I actually sold some gold to buy this penthouse. And that's when I say my YouTube subscribers will probably skewer me for disclosing that. But, at the time I looked at the opportunity and thought this makes a lot of sense to me. And so back to having rules and following them, I write myself a promissory note in this case where I borrow the gold from myself. It's physical gold. That's what I own. Lend it to myself to complete this purchase over a certain time horizon with a fee. And so what that looks like for me is it's got to be paid back by year's end, ounces that I borrowed plus X. And we'll see how that pans out for me.
Jay, on your timeline, you've talked about the Nord Stream shutdown, and I'm sure many of your guests, just like many of my guests as well, have a lot to say when it comes to Russia and the European energy crisis. I'm curious to hear your thoughts on Putin's longer term strategy, if one exists, or if it's really just as simple as make everybody feel pain short and in the short and intermediate term until Russia hopefully does not, but could obviously take Ukraine under its full control.
Yeah, I think that Putin has a lot more leverage. And he knows he does. If Russia takes their oil and gas offline, the world stops functioning. I think it's as simple as that. And we're seeing that right now, right? Throughout mainly Germany and the UK, the shuttering of small businesses in response to their rising energy costs is becoming really dramatic. And there's no shortage of little cafes, restaurants, B&Bs who are posting their energy bills on Twitter. You should search this. And they're seeing, 10x increase in their energy costs. And that's a simple shutdown for many of those businesses. And so that's why I wonder how much of a reshuffling we're going to see this winter, because, I think forecasts right now are for German energy to increase something like, 3,000% in the next 5 years. Like that's a great prediction, but it just means that we hit market failure, meaning hyperinflation and a complete collapse of the economy. You can't produce anything at that cost. And so that takes Germany's economy offline, which obviously contributes to just global skyrocketing inflation if that were to occur, and Germany wouldn't be alone. And so, Putin knows that he has this leverage. Most of the EU cannot survive without Russian oil and gas. Italy can't, Norway can't, Germany can't, likely the UK can't. And so what's going to happen this winter is either, we're going to see market failure in these economies. We're seeing, the tipping point right now is these small owner operated businesses are getting hit first. They always do. They have smaller margins and they're shutting their doors. That will continue, right, to larger and larger enterprise. And the politicians are going to have to make a decision about probably moving towards a detente with Russia and either paying for energy in their currency or in whatever currency Russia needs or requests, whether that's rubles or gold or whatever. And so I think this story is just getting started. I think that it's going to be a very, very interesting winter to see how this shakes out because, it's unsustainable as it currently stands. And I think there's going to be a big reshuffling here.
Yeah, it's been my observation that at least in the States, if you weren't on Twitter and seeing to your point, right, these tweets about electricity bills and all the stuff that I probably wouldn't myself have been that aware of how bad this could get for Europe or is likely to be for Europe. I don't see the mainstream media really kind of talking about this almost at all, almost like there's sort of a willful ignorance. I'm curious, do you find that there's a similar dynamic with Canadian media companies and in terms of the news? How is that being covered in Canada?
Yeah, I think so, because if you look at what's occurring on the street, it really shines a light on how much leverage Russia has in this scenario. It's a ton. It's global implications. And you're seeing all sorts of new expressions of civil unrest. UK right now has a movement going called Don't Pay UK. I think they are soliciting for 1 million signatures by October 1st. People who claim and promise not to pay their electricity bill. They're protesting the cost. So you're hearing from the people, right? And what do you do with that if you're mainstream media and you're sort of mandated to toe a line? I mean, that's what it is. And so yeah, I think it's a horrifying scenario to report on because of just how much power in this scenario Putin has. And he obviously knows it. He's not ignorant to it. I think our leaders know it. I don't think they're ignorant to it. But, at what point do you let the cat out of the bag? It's happening regardless. Like I said, there's a healthy stream of new businesses posting their electricity bills to Twitter and saying, a little mom and pop cafe was paying, what was it, $11,000 annually for their electricity. It shot up to $64,000. That's game over, right? But that will continue. That's the tipping point. Like that will continue to occur. And you either start buying Russian oil and gas or you shut down. That's going to be the choice in front of a lot of these economies.
Yeah, and that media point, that's an interesting point that maybe they don't have an incentive to cover it because it makes Putin, Russia appear stronger than they want in the narrative. But it also means there's a lot of room for negative surprises in terms of consumer spending, presumably, right? Because once it starts to hit and once it eventually does make its way into mainstream media, that might scare the population and then might cause sort of a self-fulfilling consumer deceleration, I would think.
Yeah, and I would agree, and I think we're seeing some cracks of that already. And the last thing a politician wants is to decrease confidence even more. And just yesterday I was looking at financing numbers in the United States. Something like we're coming up on 120 days since a U.S. company raised at least $25 million in a traditional IPO, which would surpass anything we saw in 2008 in terms of capital flowing into the market. That would put us back to the tech wreck, 20 years ago. At this point, thus far this year, there's been something like $5 billion raised in traditional IPOs. This time last year, it was $105 billion. And that restrictive access to capital it's interesting if you think about how many companies need to raise cash to stay alive. And if that's the case, and they can't raise it, I'm very curious what happens to the broad equities market in that scenario. Fast forwarding this current situation 12 months down the road, when companies that need to raise cash have burned through their treasury, can't go back to the market. Yeah, it's an interesting situation.
Yeah, no, very much so. Okay, let's pivot a little bit for the remaining minutes on building a media company or media empire. Now, I'm a fund manager first and foremost, and I've been out there doing content like you for quite a while. I used to be one of MarketWatch's top writers, and it dawned on me after a few years that the issue when you're creating content for somebody else is you're basically renting their audience. And if you really want to have a longer term brand, you've got to own the audience, right? You've got to have your own distribution, your own content that people follow you explicitly for, as opposed to some other avenue to then get access to you. What are sort of your longer term objectives, or what's your longer term vision with all the work that you're doing? Are you viewing the podcast, the YouTube channel, as a way of owning the audience so that you can do more conferences, or are there other goals in mind for you?
It was inspired, Michael, by the contribution I believed it would make to my own portfolio. I like a lot of people, I guess, March of 2020, my business was becoming compromised. And I was like, okay, it looks like we may have a big break here. And the reason I launched the podcast, other than, I had a decent network because of the conference business. And, I love having those conversations that I used to have on stage and all this. But it was really like, the world's on fire. There's going to be crazy opportunity everywhere. And there's nothing that I could do that would be more intelligent than sitting down with as many veteran money managers as possible and peeling apart their strategies. And that's still the inspiration today. Like, why I have the channel is like, I'm the biggest beneficiary. Like, I just am. I get to sit down with 3 experts per week and pick their brain about where they're allocating capital, and knowing that their strategies don't fit me ideally or perfectly, but I can take something from everybody. And especially if I'm finding consensus in 1 or 2 ideas, if I sit down with a dozen different money managers, I'll hear a dozen different ideas, but possibly I'll hear 1 or 2 ideas that everybody agrees on. And when I hear that consensus, that's worth paying attention to. And consensus in the mainstream market, it's a different story, right? Maybe that's a red flag if everybody's running one direction. But in the population that you might consider the quote unquote smart money. And, how do you define smart money? You just decide, right? I believe these investors are typically ahead of the herd. Therefore, I'll call them the smart money. When I begin to see consensus in one or two theses within that group, that directs a lot of my capital flow. And that's the reason I host the podcast still. I get to, pick the brains of individuals who have been in the game a lot longer than I have a bit more scar tissue than I have, et cetera, et cetera. And I didn't expect it to take off like it did, to be honest with you. It was very, like I said, a self-serving endeavor, but it's an absolute blast. And so moving forward, like that is still the game plan. It's stealing the best ideas from the people that I have access to, and the sort of list of individuals just seems to keep improving a little bit, and that's super fun. And then allocate capital accordingly. We are getting back to the event business and leveraging a whole new network of people that we've met over the last 3 years running the podcast. So it's allowed us to just up the caliber, I suppose. But it's nice having the 3 platforms, the YouTube channel, the podcast, and the newsletter, because I do have to be a little bit careful with what we say on YouTube. They're the most sensitive in terms of content and the most likely to sort of raise a flag or maybe penalize a piece if you talk about something controversial. Podcast far less so, and then the newsletter not at all, right? The benefit to filtering your audience into your newsletter is that they get the unfiltered version of you, because you don't have to worry about becoming censored. And it is a real threat right now as a content creator. It is what it is, but it's a reality, right? And it needs to be considered if creating content's become part of your business. Are you willing to lose that platform in exchange for putting an idea forward that maybe offends, I guess, the mainstream narrative? It's a real thing. So yeah, for us, it's, YouTube, podcast, top of the funnel, pushing people down towards my newsletter, where I know with confidence I can treat it like my backyard and say whatever I want and share my ideas unapologetically.
Yeah, and actually, it's funny you mentioned that point about controversy. Anybody that has followed me over the years knows that when I was a kid, I used to be a big wrestling fan. And Eric Bischoff, who once headed WCW as a company, is famous for this line in his own podcast that controversy creates cash. But in today's world, to your point, with this sort of filtering that happens with social media, you have to be careful in terms of what you say, even though selfishly you may want to say it not only because you want to get the word out and because you believe in it, but because it can actually generate some revenue and even more attention if you're being unfiltered, right? And that's a real hard line to walk, I find.
It is, and it's absolutely worth it. Having said what I just shared, we push it. And just last week we put out a piece of content. Really, I was interviewing a gentleman named Bob Moriarty, and we were walking through, I guess, the purpose and the intentions and the plans of the World Economic Forum. And Bob's perspective on that is not positive, and he was very critical. And my editor didn't want to publish it. He's like, look, this is absolutely going to get you shadow banned. You can't put this out. And notably, my editor is, his performance metrics are traction and views. So, putting out a piece that would get us penalized is not in his best interest. But, we put it out, and it did very well. It actually went quite viral as a consequence, but it was on that line, right? And we've been on that line before, and there's certain guests that I have on that I know are going to say things that are controversial. Just yesterday, we put out a piece with David Collum. I've interviewed David 3 times, and the second one got demonetized immediately because of some of Dave's views. Piece yesterday was done very, very well. So it's a bit of a lottery, man, but we yeah, I guess you got to decide for yourself how much you want to self-censor and how much of a risk you want to take. And I tend to lean towards the risk side, but that can hurt you too.
Yeah, Dave can definitely. I've had Dave on a space myself. I know exactly what you're referring to with that. Everybody here, make sure you follow Jay.
I mean, I guess time will be the ultimate stress test. So I'm not so sure it matters, right? I look at a lot of the data that comes out of our various economic think tanks and question it. Honestly, because of the way I position my portfolio, it doesn't matter so much. And that's very intentional, right? I keep it super basic. I keep my barbell super barbelled. And like I said, I'm not even in bonds when I talk conservative. I'm talking, rocks and dirt, man, to be honest with you. And I know that sounds weird. It lets me sleep at night, and I have because like I said, rule number 1 is stay alive, right? And so I can be as risky as I want to be on the risk side of my barbell, knowing that I can be completely wrong. But if I've organized my barbell effectively, it's not going to change tomorrow for me. It'll hurt my emotions and my ego, but rule number 1 is stay alive. So whatever you've got in your pocket, right? keep, versus whatever you put on the table, right? Because rule number one is stay at the table. So yeah, and I talk a lot about, I guess, like my I wouldn't say a pessimistic outlook on the world. It's not that at all. I think there's a lot of very big changes that are going to occur. That's not necessarily negative, right? I'm agnostic to the geopolitical reshuffling and what countries go where. I think it's going to be dramatic. I think it's going to impact all of us. That doesn't make it good or bad. Just makes it life. And, I'll bet all day long on human ingenuity. I'm an optimist to a fault and long term. And I always have been, always will be. But in the near term, I think that, unprecedented, it's redundant at this point. It's like, yeah, we know, right? That's going to be the trend. I think the 2020s will be how the 2020s have been, just a continuum of somewhat black swan events. And because of that, I go super cautious. I probably don't trust many of the numbers that we look at. And I don't trust the narratives I hear from the podium at all. And everyone's got a game they're playing, right? Whether it's a politician looking for job security or whatever. But, as much as I can do to retain my own personal sovereignty, that makes me sleep better at night. I got 3 very young kids. So, that shapes the way I think. And if my barbell used to be 50-50 with each new kid, it's weighted more towards the safety side. And so, I think about that a lot.
Final question on my end, Jay, and then we'll wrap up here. Out of all the guests that you've had and all the conferences you've moderated on these various panels, I'm just curious, maybe selfishly so I can invite them, who's been the most mind-blowing or fascinating guest you've ever interviewed?
So it's hard for me not to say Prime Minister Stephen Harper. I've had him on twice, and he's such a refreshing take on global events, and probably because he's been uninvolved in politics for so long now. He doesn't have a horse in the race, but I just found him to be very authentic with his answers. And I don't agree with all of his politics, but it was so refreshing to interview a politician who just answers your question. And when I sat down with him the first time, I knew, he's a former G7 world leader. The guy would be able to dance circles around me if he didn't like my questions, and I'd never be able to catch him, but he never did that. He answered everything directly and just gave me great perspective. And so I appreciated that. Naomi Prinz is somebody who I have a lot of respect for. I've read a handful of her books. When I was studying to interview Prime Minister Harper and President Calderon, one of my key research tools was her book, Collusion, where she walks through the decision-making and mindset of world leaders during the 2008 financial crisis. So very fascinating take. She's a very hard worker, very well-spoken, and an amazing financial author. I think one of the best. Who else comes to mind? I like entrepreneurs, Frank Giustra being one. He's one of the most successful entrepreneurs in the mining space, in the film and television space, founded Lionsgate Entertainment. They produce many of the best films that most of us have seen, but also one of the most successful and legendary entrepreneurs in the gold and silver space. And, the benefit there is that you just get these raw war stories from somebody like that. The hours where he's almost lost his companies and the crazy bets he made, in order to reach the multi-billionaire status that he's at. And Lord Conrad Black, phenomenal guest, actually, just to break down the media industry a little bit. He built one of the largest print media enterprises in the world, sold it. We know how that ended. The buyer bought a print media business during the fall of print media and subsequently attacked the integrity of Conrad Black's sales process. And he actually got found guilty of fraud and put in prison. But the war stories within that brain are pretty phenomenal. There's a few that come to mind.
Yeah, and this has been a real pleasure for me to have you, Jay, as the guest here. So again, everybody, please make sure you follow Jay. Check out his podcast. I'm sharing in the nest here. And enjoy the rest of your Sunday because, I don't know, I'm an optimist like you, Jay, but there's always a part of me that just worries about the sequence where you might be time to get super pessimistic before the real optimism comes in. I always go back to that point. It's like you can't bet on the end of the world, but sometimes you have to focus on it because it can be wildly painful in the event that you got pretty damn close.
Michael, this has been super fun. Thanks so much for organizing.
Thank you, everybody. Thank you, Jay. Appreciate it. Cheers, everybody.